All right, let's talk about the stock market. It's a world that can feel, well, super overwhelming, maybe even a little scary, right? But what if I told you that in just the next few minutes, we could demystify the whole thing? I'm talking about learning the simple, proven strategies to not just understand it, but to actually start building real long-term wealth. So let's dive in. Okay, first things first, let me ask you a question that gets right to the heart of why any of this matters. You work hard for your money, right? You stick it in a savings account, but is it actually safe in there? Well, the short answer is yeah, it's safe from someone, stealing it, but it is absolutely not safe from this silent thief that's eating away at its value every single day. And that thief, it's called inflation. And this is where the problem becomes crystal clear. I mean, look at this. Your savings account might be paying you, what, a measly 0.1% interest? But when inflation is running at, say, 5 to 8%, you're actually losing purchasing power every single year. That's a huge loss, and it's happening right now to your hard-earned cash. So how do we fight back against this? Well, for the last century or so, there's been one clear, historically proven engine for growing wealth and blowing past inflation, and that's the stock market. Now get ready for this number. While your bank is paying you practically nothing, the stock market, and we're talking about the S&P 500 index, which is just a tracker for America's top companies, it has historically delivered an average return of 8 to 10% per year. That is a massive difference. And that, my friends, is the key to building real, lasting wealth. But here's the thing. That 8 to 10%, that's just the start. The real magic, the secret sauce to building wealth, isn't just about those returns. It's about what happens when your returns start earning their own returns. It's a concept called compounding, and honestly, it's probably the most powerful force in all of finance. Okay, let's make this real. Let's run the numbers. Imagine you invest $1,000 a month for 30 years. Over those 3 decades, your total contribution, the money you actually put in from your pocket, is $365,000. And that's a respectable sum for sure. But thanks to the market's growth and that magic of compounding, your final portfolio is going to be worth, well, a lot more. Over $1.5 million. Yeah, you heard that right. That is not a typo. You put in $365,000 of your own money, and you walk away with over $1.1 million in pure profit. That is the power of compounding. That is the incredible engine of the stock market. Okay, so now you see the incredible potential here. Before we go any further, let's get you speaking the language. We're just going to quickly run through a few key terms you'll hear all the time so you know exactly what they mean. First up, a bull market versus a bear market. This one's super simple. A bull market is when things are rising. Think of a bull thrusting its horns up. A bear market is when things are falling. Think of a bear swiping its claws down. See, it's really just about the direction, the mood of the market. Next up is a stock index. We actually mentioned one already, the S&P 500. An index is really just a tool, like a basket, that holds and tracks the performance of a whole group of stocks. So instead of looking at one company, it gives you a quick snapshot of how an entire chunk of the market is doing. And finally, a dividend. This one's pretty cool. A dividend is basically a portion of a company's profits that they pay out directly to you, the shareholder. So it's literally like getting paid a little cash bonus just for owning the stock. All right, so you get the why and you've got some of the what. Now let's get to the most important part, the how. We're going to lay out a simple, low-stress path to get you started. When you're starting out, you basically have two main choices. On one hand, you could try to pick individual stocks, find the next big thing. It has the potential for high returns, but man, it takes a ton of research and it's pretty risky. The other option is buying an index fund. This instantly diversifies you across hundreds of companies. It's low cost, and frankly, it relies on the market's long-term average instead of you having to be a genius. And if you want to understand the risk of stock picking, just consider this cautionary tale about Intel. If you had bought this tech giant back at its peak in 2000, you would still, to this day, not have broken even. We're talking more than 2 decades later. That's a perfect example of the danger of putting all your eggs in one basket. So, what's the better way, especially for beginners? Well, for most people, the simplest and most effective strategy out there is something called the 3-fund portfolio. And trust me, it's a classic for a very good reason. And here is the beautiful simplicity of it. You've got three parts. The biggest slice is in U.S. stocks, capturing the growth of the American economy. Then you've got a good chunk in international stocks, so you're not just betting on one country. And finally, a small slice in bonds, which are less risky and kind of act like a shock absorber when the stock market gets bumpy. It's a simple, balanced, low-cost way to own a piece of the entire global economy. Okay, great. So where do you actually do this? You can't just buy these funds from your normal bank account. You need a special investment account. The most common options are a standard brokerage account, an employer-sponsored 401k if you have one, or an individual retirement account, which you'll usually hear called an IRA. Now, if there is one thing you take away from this whole guide, let it be this. For most beginners, the single best account to start with is the Roth IRA. Why? It's a total game changer. You put in money you've already paid taxes on, which means all of your investment growth, everything, can be 100% tax-free when you retire. That is incredibly powerful stuff. Okay, we are almost there. We've covered the what, the why, the how, but the final and maybe most important piece of the puzzle isn't about a specific fund or account. It's all about having the right mindset to actually succeed. And this right here is the single most important rule in investing. Period. You have to forget about trying to guess the market's ups and downs. The real key to building wealth is time in the market, not trying to time the market. It's all about just staying invested for the long haul. And look, if you're worried about the market crashing and losing all your money, here's a little fact that should help you sleep at night. Historically, over any 20-year period, U.S. stocks have never had a negative real return when you include dividends. Let that sink in. The longer you stay invested, the more all that scary short-term noise just fades away. So what's the big takeaway from all of this? It really boils down to this one simple, powerful idea. Stop worrying about whether now is the right time to buy. The secret to success isn't about timing. It's about consistency. Just keep buying, keep investing over time. Let the market and that incredible power of compounding do all the heavy lifting for you. The only question left is, when are you going to start?